What's going on, traders? Welcome to the channel. I'm John. That is my trading partner, Genius. We trade options here. All right, so we are going to be talking about something very important, especially for any new traders. Maybe you're someone who's brand new to the market. Like this might be your first stock ever, or if you're looking at options and you're not too familiar with the options market. I have a little experience. I'll try and share with you kind of my thoughts, my ideas, but keep in mind this is not financial advice. It's just my risk, kind of what I'm thinking, my diary. It's my diary in the markets. And this is my risk. This is what I trade with, but I'm going to explain to you some assumptions you need to make, some ways to take risk off the table, some ways to kind of leverage yourself in a good way so that you can take the most advantage possible out of the price swings in AMC, GME, any stock that you're looking at that's very volatile in general. And then lastly, I'll kind of explain like, hey, if you got like a $5,000 budget, like if I was starting over and I had $5,000 as budget, this is probably how I'd do it and how I'd utilize it and go from there. Okay, so let's jump into it, and also drop me a like. Let's get this out to the community. It's really important. Likes are free. I don't charge you, but help us get this out to the community. It's totally free. I thank you for that, and let me start diving in. So on the recent video, this is the latest video we had. AMC was trading pretty high actually about 2 days ago, and we were up above the $50 level. And now you can see I'd said, hey, I think 50 is a key level that most big money manipulators want to kind of crush. They want it to go lower. So I did assume we'd maybe have a chance at hitting this trend line, and lo and behold, we did. That was very interesting. So just bear in mind, the biggest thing, the biggest key takeaway I'll give you for sure is there's just massive ebbs and flows with the market. You see up, you see down, you see up, down. Sometimes a greater trend picks up and it goes bananas, and that's this. You probably saw that, but remember before, lots of ups and downs, right? Up, down, up, down, up, down, up, down, shoots to the moon. Right, so same idea here, tons of ebbs and flows. Kind of the thing I do is I like to take advantage of those ebbs and flows, and then I want to also be exposed for another big time move like that. And that's kind of what I'm going to set you up for to understand from the psychology perspective. We'll talk about risk mix, understanding like the emotions and psychology that go through your mind, and then we'll talk about the right and wrong times to be buying those options, and I'll explain my strategy, if I was starting over with like say 5K, and we'll go from there. All right, so let's just dive in. First and foremost, let's talk about if you're new and you're considering a position. This is the first thing you do no matter what. Honestly, even to this day, me being a little more experienced, quite a few years in the market, I still do this, and really YouTube has been helpful for me because it's kind of like my journal or my diary, I guess. You need to write your expectations and your plans, right? So keep in mind, if you buy this stock, your obvious expectation is it goes higher, right? But what if it does that? What if it starts going crazy lower? What if it starts shooting much, much lower? I mean, are you prepared to handle that? When you entered this position, did you actually prime yourself, tell yourself what you were going to do if we go lower? Most people probably don't. So write out your plan. If you have, say, a budget that you're putting into this stock, and have you thought about what if it gets cut in half? What if it goes lower than you thought? What if it drops 10 points? I mean, where is your sell point? Like, where are you interested in selling the stock? And keep in mind, these market manipulators, they like to go below support lines. So see this right here? Went well below it. See this right here? They like to shoot lower to see if they can shake you out of your shares. See the $50 level? This is what everyone was talking about with support, and then guess what? It went below it, and now we're touching near it again. Who knows if we go higher or lower, but you need to prepare yourself just in case. And honestly, to the upside, let's just say it keeps going higher, and you didn't create a plan for yourself, you're just in as much trouble, because guess what? If this stock continues to go higher, the first thing you'll do is you'll say, oh, I should have put way more money into this. Why didn't I put every dollar I own into this move? I'm such a genius, well, that's very unhealthy. It's kind of like a gambler's fallacy, where the next time you decide to make another trade, or you get a hot tip from somebody, well, you're going to put everything into it, and then what if it doesn't work out? I mean, me as a trader, I still recognize the probabilities, and I still am okay on days that I lose a trade because I allocate enough to assume a loss on a trade, right? So that's the thing. And I have the rights but not the obligation. I'm not obligated to own 100 shares at the $50 price level. So basically, I would pay $17 of what we call premium. This is like saying I'm paying you $17 for the right to own the $50 strike and own 100 shares at that level. So if I decided to ever exercise that contract, I would basically pay $5,000 and I'd own 100 shares at this price. And you unfortunately lose out that $17 or whatever it is. But let's just talk about this, that most people don't exercise their options. So you're just kind of trading on value. You're saying this contract has this value at this time, and if we're making this bet, I'm basically putting $17 into a very low probability trade that we are above $50 a share tomorrow. So tomorrow's expiration, I'm betting we're at or above $50 a share if I decide to take this trade. But conversely, let me go out to the longest one here at 855 days out. $50 a share, that is not $17 there. This is $29.20 multiplied by 100. So that puts you at $2,920 to own this contract, but own it for the expiration date in 2024. So that is a big difference. There's a big delta there. But as an example, you could see how that contract lost a lot of value. You know, the $50 call contract expiring tomorrow, a few months ago was worth a lot more than the $17, and you're even seeing this now here at this setup there. So from that, let's give it a starting point to see. So as an example, you can also do other things. Instead of a $50 strike, what if we move down to so that leads me to the next thing that's really important, which is what good traders and bad traders do. So a few days ago, we had talked about being above the $50 level and saying, hey, this could go lower. It did, we tested lower, but here's what's important. So check this out. The sentiment was very high. And what happens is these really smart, big money funds, I mean, they have it easier than anything now. They can measure the pulse of the market. They can check Reddit. They can check Twitter. There's a bunch of algorithms that can look at stock mentions and figure out what the sentiment is. And they realized that at this point, the sentiment was very high and people were buying call options at this level. And then guess what? As it dropped, you know, someone moved that market. As it dropped, your call options lost significant value. So this is a good one. It's like, when is a good time to buy options? I'll tell you right now, just a quick summary. Buying it when it's doing this and everyone's pumped and you're seeing it just all over the internet, that's a really bad time to buy them. But when things are going lower, it's really hard, right? You see this down bar. Technically, this was a big red bar during. That is a hard time to be like, oh, I'm willing to buy a falling knife, right? But you're getting call options on a discount, and I'll showcase that for you so you can see. If we go here, let's just go like 30 days out. So this is the October 15th expiration date. I'll use the 50 as an example again. It's just kind of easier, right? So right now, if I was to buy the $50 call option, I'd be paying $510. So that's 510 multiplied by 100 for the 100 shares. $510, that's my max loss. Fine, that's today. That's with the stock market for AMC and its current trading price here. That's where we'd be, right? And as of a few days ago, this 50 call option, and now just 2 measly days later, it lost half its value, right? But if you would have had the patience to just assume maybe this goes lower and the sentiment changes and things look a little bit bad, you could have bought this at $400, $496. You basically could have bought 2 call options for the price of 1. Or if you bought it when the hype was high, you bought it at a premium and now it lost half its value, right? So that's kind of like just a very simple illustration to show you the ebbs and flows of the market. You know, a good time to buy versus bad, the sentiment in the market, the amount of FOMO that goes in, you know, people start kind of freaking out and getting excited. That's a tough one, right? I get it. I've been there. I understand that. And just having a little discipline, or say starting with like a test position, that can be really helpful. And this is one example here too. So this is kind of what I did when there was a little bit of hype, but I did have a bias that we'd continue higher, honestly. And so when I bought this 145 call option for January expiration, I said to myself, hey, this is costing almost $700, pretty expensive. And now the current value is 279. But what I ended up saying is, hey, I was going to allocate for at least two, maybe three call options. I said, hey, I'm going to do just a single test entry first. Let's see how it goes. Well, lo and behold, a few days later, next thing you know, it cut in half, and I was able to buy that option at $381 instead of the 685. So that just gives you an idea of tolerance, taking risk off the table. So the next one we'll just kind of talk about is just my general overall strategy. Personally, I'm a fan of the idea here of an 80-20 mix, or like a 90-10 mix, where the majority, the 80 or 90%, is in shares. So you're buying physical stock, you own the stock, it doesn't expire, and then the rest you use for that speculative trade. Because what can happen is if things do take off, then that 20 or 10% options that you did can actually have a big impact on your account. Obviously, it's not as good as if you did all options and things went well, but who has a crystal ball for the market? I mean, I don't. Totally wish I did. If someone has one, let me know. So like as an example, this 100 shares I use as collateral, and like that $50 strike I had talked about, it was $1,000 2 days ago. You know, you sell that $50 call against my 100 shares, and by doing that, I pocket the premium when I give it back to the market, when I buy to close my covered call. And so for an example, in that case, it was a $500 difference. I just pocketed that $500 difference by selling a covered call, or writing a covered call contract to the market. And that's kind of a way to explain it. And I just rinse and repeat whenever the sentiment gets high. I kind of take the opposite, almost contrarian approach to that. If sentiment's really, really high, that's kind of when things are very expensive. It might be worthwhile to, for example, maybe sell some premium against that. And what I've done though too is I'm trying to keep my exposure low, so I don't try. So now let's talk about something important. Let's say $5,000 is the way I'd think about that for myself is if I was doing an 80-20 approach, 5,000 times the 80%, I'd basically put about $4,000 or so into AMC shares. You could do, it's 4604 currently, so 4,604, and you could start selling covered calls against it. The rest you'd have to figure out if you want to just leave that for. So that's a strategy to start with. The other one that I would be considering on that 80-20 mix that I like to do, $4,000 into AM for the shares. And then what I do, I can use a very cool tool. It's called optionsprofitcalculator.com, just totally free. If you go on there, it's a really nice tool to use. And on that, here's the home page. If you go here, it says use options finder. I can actually put in my budget. So as an example, I'll put in the symbol AMC, the stock price, and then so 72, and then let's just say I'm looking at November for expiration. And if I put my maximum risk that I want to put in, let's say $1,000 here, it will now find me the certain calls that I can look at. So I'm just looking at a long call. Basically, there's a call I want to purchase. This is my budget here at $1,000. And if say you wanted to own like maybe two of them, you could also change your budget to like 500, and then it'll tell you these here. But as an example, this is going to return to me the 5 top ROI percentages that I could do with my risk that I'm willing to put into the market. So by this, it's saying, hey, if you buy the 47 call expiring in November, this is what you'd pay, $975. This is the estimated return if the stock trades to the price you talked about. So 72 is like brand new high. This next video does explain how to trade a really expensive stock at $3,000 a share, like Amazon, using a really small budget, like say $500 or $1,000.